Welcome to the Deep Dive, the show where we take your sources, break them down, and give you the essential insights you need.
That's right.
Today, we're doing a custom deep dive for you, our listener, into one of the world's, well, most formidable financial institutions, Apollo Global Management, ticker symbol APO.
Big one.
Yeah, and we're tackling a fundamental question here. Is Apollo Global Management truly an all-weather capital compounder? Or does its immense complexity actually hide some significant vulnerabilities?
That's a great question.
By the end of this deep dive, you'll have a much clearer picture. And we might just reveal if the broader market is, missing something big with this company. All our data is as of June 24, 2025.
Indeed. Our mission today is really to extract the most important nuggets of knowledge from the comprehensive APO stock deep research analysis that you've provided. We'll be dissecting its dual-engine business model, scrutinizing its leadership, pulling apart the financials, and looking at everything from market sentiment right through to potential risks.
So not just what Apollo does, but why it matters.
Yeah. Exactly. Why it matters, and how its unique structure really sets it apart in the space.
Okay, let's unpack this fascinating company. Chapter 1, Business Analysis. The modern alternative asset titan.
Okay, so at its core, Apollo Global Management operates this highly synergistic dual-engine business model.
Dual engine.
Yeah. First, you have the traditional asset management segment. This is the heart of their operations, really, focused on raising and managing capital for clients across different strategies.
And numbers are huge, right?
Immense. As of March 31st, 2025, this segment managed something like $641 billion in credit assets and another $144 billion in equity assets. That's the bit most people think of, when they hear alternative asset manager.
Right. But then, and this is where it gets really interesting, you mentioned their retirement services segment, principally through Athene.
That's the key differentiator.
And it's not just diversification, is it? You said it's a profound structural advantage. How does that work exactly?
Absolutely. It's more than just another business line. Athene issues annuities, okay? And that generates what's called float.
Float, like insurance companies have.
Precisely. Think of float as the premiums customers pay in, which Athene gets to invest before it has to pay out any claims down the line. This creates this massive, stable pool of permanent capital.
Permanent capital. That sounds powerful.
It is. And what Apollo does with it is incredibly clever. Their robust credit origination platform takes this float and invests it into high-quality income-generating assets.
So they're investing Athene's money.
Yes, but it's more integrated than that. It creates this powerful flywheel effect. As Athene grows, it constantly feeds more capital to Apollo's asset management side, which then deploys it, generating more assets and, crucially, more fees. The symbiotic relationship gives Apollo a distinct cost of capital advantage. It's a powerful competitive moat.
Okay, so this unique capital engine, how does that translate into their actual investment offerings? What can they do that maybe others can't?
Well, their investment capabilities are incredibly broad, but it's the scale and that integration that really sets them apart. Credit is their absolute core strength, with that $641 billion in AUM. They offer a full spectrum of financing solutions, often stepping in where banks have pulled back.
Filling the gap.
Exactly. Then there's equity, their traditional private equity arm, $144 billion AUM there, grounded in a very disciplined, value-oriented philosophy. You always hear them say, purchase price matters.
Right, value investing.
And finally, real assets, investing across critical infrastructure and real estate. So this comprehensive suite, backed by Athene's capital, means they can offer bespoke, flexible solutions on a scale that few rivals can even dream of matching.
That sounds like serious market power. Where does Apollo truly stand among the giants? Blackstone, KKR.
Oh, Apollo is undeniably a titan. At year-end 2024, their assets under management, their AUM, it surpassed $751 billion.
Wow.
Yeah, puts them firmly in the top echelon, competing with behemoths like Blackstone, which is over $1 trillion, and KKR, maybe around $550 billion.
Right up there.
Right up there. But Apollo's strategic emphasis on credit and that merger with Athene, it uniquely defines its position, makes it kind of a hybrid player.
Interesting.
For context, they deployed $15.2 billion in just the 12 months ending March 2025. And their scale lets them do these massive transactions, like that recent $4.5 billion private credit deal for Électricité de France. That AUM isn't just a number, it's the bedrock of their power.
Allows them to do deals others can't touch. And what's their core value proposition to investors? What's the promise?
It's all about generating excess return per unit of risk. That's the mantra.
Okay.
And it's underpinned by that disciplined, value-oriented, often contrarian philosophy they've honed for, over 3 decades now? It emphasizes rigorous underwriting and, really importantly, downside protection. They're not chasing fads. They're looking for value where others might not see it.
Or others can't fund it.
Or can't fund it, exactly.
Let's broaden our view a bit. What major trends are shaping the whole alternative asset management space right now?
Yeah, we're seeing a pretty pivotal transition. The era of, cheap money, that seems to be over.
Right.
Which is fundamentally shifting the focus away from just financial engineering towards actually creating operational value in the companies they own.
Makes sense.
Key trends. Well, the explosive rise of private credit, it's filling this massive financing gap as traditional banks retreat. We're talking over $620 billion in high-yield bonds and leveraged loans needing refinancing by 2026, 2027 alone. Huge numbers.
Wow, massive opportunity there.
Huge. Also, infrastructure and energy transition that demands trillions in investment, becoming a super attractive asset class. Something like 46% of institutional investors plan to increase their allocations there.
Trillions.
And finally, the retailization of alternatives. This is opening up a vast, previously untapped pool of high net worth capital, moving these complex products beyond just the huge institutions.
So the market's changing fast. Who are Apollo's main rivals in this dynamic landscape?
Oh, it's fiercely competitive, dominated by a handful of these publicly traded mega firms. Apollo, Blackstone, KKR, Carlyle, Ares.
Usual suspects.
The usual suspects. Competition for deals is intense, pushing these firms to compete on capabilities way beyond just writing the biggest check.
So it's not just about money anymore.
Not just money. Apollo's proprietary AI and digital platform, for instance, designed to drive operational improvements in their portfolio companies, and their unique ability to offer those bespoke financing solutions. Those are critical differentiators. They're competing on sophistication now.
And how's the regulatory environment affecting them? Getting tighter?
Globally, yeah, scrutiny is definitely tightening, especially as these alternative products become more accessible to retail investors.
Makes sense. Regulators worry about the little guy.
Exactly. They're focused on fee transparency, potential conflicts of interest, asset valuations. You've got things like the U.S. Corporate Transparency Act, adding compliance burden, the U.K.'s FCA reforming its rules. Navigating this complex regulatory maze is a big challenge for all of them.
Given all this, the scale, the complexity, the regulation, how difficult is it for a new player to even think about competing at this top tier?
The barriers to entry. Exceptionally high, almost insurmountable, really, for firms like Apollo. Their $751 billion AUM gives them immense scale and operational leverage that smaller players just can't replicate.
Plus the brand name.
Absolutely. A powerful global brand, over 30 years of track record. That builds trust, attracts capital, but maybe their most formidable barrier is that integrated ecosystem we talked about, combining top investment capabilities with that massive permanent capital base from Athene.
The flywheel again?
The flywheel. It's a built-in advantage that is incredibly difficult to copy.
It sounds like an ironclad competitive moat.
Yeah.
But are there any emerging threats? Anything that could challenge even Apollo's advantages?
Well, while their advantages are strong, the industry never stands still, right? For instance, the constant demand for more transparency from big investors could put pressure on their fee structure, the classic 2 and 20.
Where the fees are high.
And the rise of smaller, highly specialized boutique managers could maybe chip away at certain niches, even if they can't match Apollo's overall scale. But yeah, that immense AUM creates huge economies of scale. They centralize functions. They even use AI to cut procurement costs for portfolio companies by over 65%.
65%, wow.
Yeah. And the Athene flywheel, it creates powerful network effects too. As Athene grows, it reinforces Apollo's origination power and attracts even more capital. It feeds itself.
And beyond just scale, what about unique capabilities? What does Apollo really bring to the table that stands out?
They talk about their integrated origination machine within their Apollo Capital Solutions group. That's key. They also boast the proprietary AI and digital platform driving value beyond just financial tweaks.
Going beyond the spreadsheet.
Exactly. And maybe most ingrained is their contrarian, value-oriented culture, that purchase price matters philosophy. These aren't just buzzwords. They seem to be real operational advantages.
Okay, fascinating stuff on the business itself. Let's talk about the people at the helm, the management, Chapter 2. Management evaluation, a contrarian and disciplined hand.
Right. Leadership at Apollo, it's really defined by continuity and conviction. Co-founder Mark Rowan became CEO back in March 2021.
Rowan. Yeah.
He brings this unparalleled historical perspective, a deep understanding of the firm's DNA. And the broader team, it combines long-tenured partners with, seasoned executives they've brought in from other top financial institutions. It's a blend.
You mentioned Rowan's continuity, but beyond just being there a long time, how has his specific vision, especially those often contrarian macro views, really shaped Apollo differently from its peers? Can you give an example where that view maybe paid off?
Yeah, that's a crucial point. Rowan is known for having these clear, often contrarian macroeconomic views. For instance, his very vocal stance on inflation, questioning Fed rate cuts when maybe others weren't quite there yet.
I remember reading about that skepticism.
Exactly.
Yeah.
And that worldview, it directly shapes the firm's investment strategy. Apollo's credit-oriented portfolio, for example, is explicitly positioned to perform well in a higher interest rate environment. That was a conscious bet.
A bet that seems to have worked out lately.
It certainly seems that way given recent market dynamics and, the smooth succession after co-founder Leon Vlach's departure, plus those significant governance reforms they made. It highlights their ability to manage crises and maintain stability even through leadership changes.
What about transparency and ethical reputation? That's always a focus in this industry.
Apollo has made pretty significant public efforts to enhance governance and transparency. That seems important to them.
Like what specifically?
Notably, they simplified their corporate structure after the Athene merger to one share, one vote. That was big. And they reconstituted their board with a 2/3 independent majority. They also provide extensive public info, showing a commitment to, transparent communication.
So how do they allocate capital? Is it growth at all costs or more strategic?
Their strategy seems laser-focused on strengthening the core business and expanding that origination engine, feeding the flywheel.
Got it.
M&A is strategic, not just empire building. They've acquired specialists like Bridge Investment Group for real estate or the State Group for infrastructure, things that enhance their platform. They also invest heavily in internal innovation AltoS platform, fintech spin-off Lyra Client Solutions. They even incubate B2B AI startups through something called 25-meter Evolve to help their portfolio companies.
Interesting. Using tech to boost their holdings. And what about returns to shareholders? Dividends?
Yeah, they have a clear commitment to returning capital, consistent and growing dividend. As of our analysis date, June 24th, 2025, it's $D.51 per share quarterly, and it's actually increased for 3 consecutive years.
Solid growth.
And the payout ratio is healthy, around 33.63%. So they seem to be balancing shareholder returns with reinvesting in the business pretty well. Now, when we look at how effectively management uses that capital to actually generate profits, we turn to return on invested capital, or ROIC.
ROIC, right. Crucial metric.
Especially for a complex firm like Apollo. It shows how much profit they squeeze out of the capital they deploy.
And what does Apollo's ROIC tell us? Is it a steady performer there?
Not steady at all, actually, which is, typical in this industry, especially for a firm with significant market exposure.
Volatile, then.
Very. It peaked at 10.9% in 2024, but get this, it was negative 18.0% in 2022 during that period of market stress.
Minus 18%.
Ouch, yeah. The trailing 12-month ROIC is 10.0%. Now, for context, when ROIC consistently beats a company's weighted average cost of capital, that's a strong sign they're creating economic value.
So are they?
Well, that 2022 number highlights their sensitivity to downturns, but the strong rebound shows they can generate high returns in good environments. The real insight isn't just a single number, it's the long-term trend relative to their cost of capital, especially through different market cycles. That shows how effectively they're compounding capital over time, not just in the good years.
Okay, so a complex picture operationally. Let's pull back the curtain on the numbers themselves now. What do Apollo's financials truly reveal? Chapter 3, Financial Analysis, Deconstructing the Numbers.
Right, let's get into it. Here's a snapshot of Apollo Global Management's key financial and market metrics as of June 24th, 2025. Market cap, $76.9 billion. Share price, around 138.74 cents.
Okay.
Their trailing 12-month, or TTM, revenue is $24.4 billion. Price-to-earnings ratio, PE, stands at 23.50x. Earnings per share, EPS, at $5.71. Forward dividend yield is 1.52%.
And the volatility.
Yeah, look at the 52-week range. High was $189.49. Low was $95.11. Significant swings. And short interest as a percentage of float is 6.11%.
Okay, dramatic is a good word. Apollo's revenue growth has been explosive, but also highly volatile. capital.
How explosive.
From $2.35 billion in 2020, it surged to an incredible $32.64 billion in 2023.
$42 billion from 2. Yeah. Then it pulled back to $26.11 billion in 2024. So if you average it out, it's an impressive 48.4% annual growth over that period, but that average really masks huge swings year to year.
And why such wild swings? For most companies, that kind of volatility would be a major red flag.
Right, but here, it's not necessarily a red flag. It's largely driven by that retirement services segment, Athene. Its revenue is directly tied to financial market performance and interest rates.
Athene again.
Exactly. For example, in 2023, retirement services revenue grew by an incredible 255%. Just nuts. While asset management grew by a more, let's say, conventional 27%.
Give difference.
Huge. Then in 2024, when total revenue fell, retirement services was down nearly 25%. So this volatility isn't just noise. It reveals Apollo's unique sensitivity to market cycles. It makes it less of a steady compounder in the traditional sense, but maybe a high beta play for those who understand its drivers.
So for a clearer picture of recurring earnings,
you really need to focus on more stable metrics like fee-related earnings, or FRE, and spread-related earnings, SRE. They give a better sense of the underlying engine.
Got it. How do their profit margins stack up with all that volatility?
They're also highly volatile, as you'd expect, mirroring the revenue. For 2024, gross margin was 90%, operating margin 85%, net profit margin 17%. Pretty good. But look at 2022, that tough market year. Their net profit margin was negative 15.68%.
Oof.
Yeah. Shows the huge impact of investment gains and losses on their bottom line. Compared to peers like KKR, their net margin can be comparable in good years, but it's just inherently unpredictable.
Now, free cash flow. For most companies, negative free cash flow is bad news, but it's often different for financials, right?
You're exactly right. On the surface, Apollo's recent TTM net cash flow is negative $1.95 billion. It was negative for fiscal 2024 as well.
See, that sounds bad.
It sounds bad, but for a firm like Apollo, this isn't operational distress. It's actually a sign of aggressive capital deployment. For most companies, negative cash flow means burning cash. But for a financial like Apollo, it's often the opposite, a sign of growth. It reflects them actively originating and putting massive amounts of capital into new income-generating investments. That's their core function.
Investing heavily.
Massively. In 2024, they reported record origination volume, that's new loans and investments of over $220 billion, plus another $56 billion in Q1 2025 alone. So the negative free cash flow reflects these huge outflows into new assets. It's the business model in action.
So not burning cash, but strategically investing it. What about earnings consistency then? Is EPS reliable?
Their GAAP EPS has been highly inconsistent. Swings from $8.32 in 2023 to negative $3.43 in 2022.
Wild.
It is. And it's due to the lumpy nature of performance fees and investment income. This EPS volatility isn't really a flaw, it's more of a feature. It highlights that traditional earnings metrics kind of miss the true picture for Apollo.
Yeah, let's look elsewhere.
Yeah, the real signal for long-term growth and stability lies in their fee-related earnings, FRE, and spread-related earnings, SRE. Those show the consistent underlying earning power, more independent of market swings.
Let's talk debt. It can look high on paper, but again, context is key for a financial giant, right?
Correct. Analyzing Apollo's leverage is complex, no doubt, mainly because they consolidate Athene onto their balance sheet. Reported debt-to-equity ratios vary widely depending on how you slice it.
But is there a trend?
Encouragingly, yes. The overall consolidated ratio has trended downward, from like 275% down to 88% over the past 5 years. That's a good sign. And the debt directly held by the asset management segment itself, which is maybe a clearer indicator of operational leverage, is a much more manageable $4.28 billion.
Okay, that helps clarify. What about their current ratio? You mentioned it was low.
Approximately 0.80. Now, in a typical manufacturing or retail company, that would scream liquidity problems.
Right, below 1.0 is usually a warning.
But for a financial institution, it's different. Their assets are primarily financial instruments, loans, securities, not inventory. They're highly liquid. Plus, they have $25 billion in cash and that predictable cash stream from Athene. So the low ratio is far less alarming here, not really an indicator of distress.
Oh, okay. And dividends. You mentioned growth earlier. How stable are they amidst all this financial volatility?
Very stable, actually, with a positive growth trend. They pay a regular quarterly dividend, and they've increased it for 3 consecutive years now.
That's reassuring.
Yeah. The current annualized dividend is $2 or 4 cents per share, with an 8.57% one-year growth rate. Now, the 5-year growth figure looks negative, but that's misleading. It reflects a prior rebasing due to corporate structure changes. The current trajectory is definitely positive and seems sustainable given their underlying cash generation.
Finally, let's get to valuation. How does Apollo stack up against its peers using market multiples?
Okay, relative valuation. Apollo's TTM PE ratio is around 23.2x to 23.5x. That's actually slightly higher than its own 10-year average. But here's the interesting part. Compare that to giants like Blackstone at 38.2x and KKR at 37.1x. Apollo looks quite attractively valued relative to them.
That's a big gap. What does that signal?
Well, it could signal higher perceived risk in the market for Apollo. Or, for those who really understand and believe in its unique integrated model, it could represent a potential undervaluation opportunity. The market might not be fully appreciating the Athene synergy.
Right. And when we try to look beyond market perception to intrinsic value, what does a discounted cash flow or DCF model suggest?
Yeah, the DCF model here is pretty crucial because it tries to cut through that market noise. It estimates value based on projected long-term cash generation, which, as we've said, can be volatile but potentially immensely powerful for Apollo.
So what's the number?
An educational DCF model from Alpha Spread, updated recently, calculates an estimated intrinsic value for Apollo of approximately $179.17 per share.
$179?
Yeah.
Okay. So what does that mean compared to its current price?
Well, compared to the analysis date share price of $138.74, this model suggests Apollo's shares could be undervalued by roughly 25%.
25% potential upside based on this model.
Based on this model, yes. Now, it relies on key assumptions, of course, like 13% revenue growth, net margin trending down slightly, but it provides a useful, fundamentals-based benchmark. And it does suggest a significant discount relative to its potential underlying earning power.
That's a fascinating insight. Let's transition now to what the broader market, particularly Wall Street analysts, thinks of Apollo. Chapter 4, Market Sentiment. Reading the tea leaves.
Okay, Wall Street sentiment. The professional analyst community, well, they're broadly positive. The consensus is moderate buy or strong buy from 20 to 26 analysts covering the stock.
Any sells?
Notably 0 sell ratings, which is actually quite rare for a company this big and complex.
Interesting. What about price targets?
The average 12-month price target falls in a pretty tight range, around $156 to $160. That implies a potential upside of maybe 14% to 18% from the current price. So on paper, Wall Street looks bullish.
But when we look at recent news, the general media tone is the narrative just as positive.
It's more of a mixed picture, honestly. Reflects the complexity we've been talking about.
How so?
Well, you certainly see reports highlighting record organic inflows, strong origination volumes, strategic acquisitions, all painting a positive picture of momentum, growth.
The good news.
The good news. But that's often tempered by more cautious reports focusing on significant insider selling, which we can discuss, and the broader macroeconomic headwinds facing the whole private equity industry.
Right. Bigger picture concern.
Exactly. Their most recent Q1 2025 earnings call, for example, was generally characterized as neutral, kind of balancing those strong fee-related earnings with rising costs and competitive pressures. So not a slam dunk positive narrative.
So the market seems to be weighing risks, despite that analyst consensus. What do the cold, hard market indicators tell us? Like short interest, that often signals skepticism, right?
It does. Short interest for Apollo stands at 6.11% of the float. Now, that's not extremely high, but it is moderately high. It definitely suggests a non-trivial segment of the market holds a bearish view, betting against the stock.
And what about days to cover?
That's 14.36 days, which is quite long. It means, theoretically, it would take over 14 days of average trading volume for all the shorts to cover their positions. This does create the potential for a short squeeze if some really positive news hits and forces shorts to buy back shares quickly.
Okay. And how does the price itself compare to its moving averages? Does it align with that bullish analyst view?
Not entirely, no. The share price, $138.74. It is trading above its 50-day simple moving average, $133.48. That suggests positive short-term momentum.
Okay, short-term positive.
However, it's trading below its 200-day moving average, $146.66, and that usually suggests a broader, longer-term downtrend is still in place.
So a disconnect.
Exactly. That's what's fascinating here. You've got fundamental analysis, the DCF model, the analyst consensus, all pointing towards a strong, possibly undervalued company. Yet, the market's actual price action and positioning, like the short interest and the 200-day average, suggest participants are weighing the risks much more heavily.
So why the disconnect? What do you think is driving that market skepticism specifically? Is it just the complexity or something else the market struggles to price?
I think it's a combination of factors. The complexity of consolidating a theme definitely plays a role. It makes traditional financial analysis harder, so some investors might just, stay away.
The too hard pile.
Exactly. Then there's the perception of high leverage, even though we've talked about the nuances of debt for a financial institution. Also, the lumpy nature of their reported GAAP earnings, despite the underlying stability of FRV and SRE, can deter investors who prefer smooth, predictable growth.
They want steady quarter-over-quarter increases.
Right. So the market, in essence, seems to be applying a kind of complexity discount that maybe the fundamental models aren't fully capturing, or that value investors might see as an opportunity.
That makes a lot of sense. So who actually owns Apollo? Let's dive into that structure. Chapter 5, ownership structure. Who owns Apollo?
Okay, ownership. Apollo's shareholder base is dominated by large institutional investors. They own somewhere between 60% and 77% of the shares.
Big institutions. Like who?
Top holders include giants like Vanguard, Capital World Investors, BlackRock, the usual suspects again. This typically provides a degree of stability and long-term orientation to the stock, as these aren't usually short-term traders.
But are they actively trading?
Recent 13F filings do show active trading among these top holders. Buying and selling reflects their differing views on near-term prospects, I suppose.
Okay, and what about insider ownership? That's often seen as a crucial alignment indicator.
Oh, this is a defining characteristic for Apollo. Insiders, founders, top executives, they hold a massive stake, ranging from 20.4% up to 29.0%.
20 to 30%. That's huge for a public company this size.
It's enormous. Founders like Leon Black still holds about 6.9%. CEO Mark Rowan has between 4.8% and 6.0%. Joshua Harris has 6.0%. They maintain these huge positions. It ensures deep, undeniable alignment with shareholders because their personal wealth is so significantly tied to the company's performance.
We've also seen some significant insider selling over the past year. The sources mentioned $502 million. For many listeners, that's a classic red flag. You mentioned rebalancing, but how can we confidently tell that apart from a lack of confidence? Is there a metric or context that really backs up that optimistic view?
That's a very fair and important question. You're right. $502 million in net selling over a year sounds concerning on its face.
It does.
However, context is crucial here. For founders whose personal wealth is overwhelmingly concentrated in a single stock, like Apollo, these sales often appear to be part of long-standing pre-planned programs, things like 10b5-1 plans designed for portfolio rebalancing and diversification.
So planned diversification, not panic selling.
That's the interpretation, yes. And the key context supporting it is the sheer magnitude of their remaining ownership. When you see founders still holding billions of dollars worth of stock, even after selling hundreds of millions, it strongly suggests their fundamental belief in the company's long-term prospects remains intact. It looks more like managing personal risk concentration than a loss of faith in Apollo itself. The size of the remaining stake is the more powerful long-term signal here.
Okay, that context helps. So ownership is highly concentrated overall, beyond just the insiders.
Precisely. The top 25 shareholders alone control over 70% of the company, mostly those founding partners and a few very large institutions.
What does that mean for the stock?
Well, it generally fosters stability and a long-term orientation. These big holders aren't likely to be flipping shares day to day. However, the flip side is that a significant change in position by just one or two of these major stakeholders could potentially have an outsized impact on the stock price. Something to be aware of.
Definitely. Okay, let's get to the nitty-gritty now. A full 360-degree view of the risks and opportunities facing Apollo. Chapter 6, Risk Assessment. A 360-degree view.
All right, let's use a SWOT analysis framework here, starting with Apollo's core strengths, S.
Go for it.
First, its diversified integrated business model, that Athene flywheel providing the durable low-cost capital base. Huge strength. Second, its massive scale and AUM, that $751 billion, gives it significant market power. Third, a strong brand and track record built over 3 decades, which helps attract capital and deals. And finally, its disciplined, contrarian investment culture, that purchase price matters philosophy, which has historically delivered results.
Okay, those are compelling strengths. What about the weaknesses, W, that could create headwinds?
Key weaknesses. Well, we've hit on this. Earnings and revenue volatility, driven by performance fees and investment income, makes forecasting tough. Then there's a high leverage when you consolidate Athene's insurance business, $362.7 billion in liabilities. Even if manageable for a financial firm, it adds complexity and risk perception.
The complexity itself is a weakness.
Yes, the overall complexity of its structure and strategies can lead to that complexity discount in the market we discussed. And finally, they have a high fee structure, the classic 2% management fee, 20% performance fee in an industry facing increasing pressure on fees.
Makes sense. What are the big opportunities, for future growth? Where can they win?
Significant opportunities lie in the continued growth in private credit, just filling that void left by banks. Huge runway there. There's also vast potential in global and retail expansion, tapping into emerging markets and that growing pool of high net worth individuals.
Making alternatives mainstream.
Exactly. They can also pursue strategic acquisitions to further enhance their platform and capabilities, bolt-on acquisitions, and sustainable investing is a massive opportunity. Apollo is already targeting $50 billion in clean energy and climate solutions, aligning with huge global capital flows.
50 billion is a big target. Okay, and the external challenges, the threats that could trip them up.
Well, they face intense competition from the other mega firms. That can drive down returns and make deals harder to win. They are inherently vulnerable to market volatility and economic downturns, which directly impact portfolio valuations and their ability to exit investments profitably.
Market risk is always there.
Always. And they are subject to increasing regulatory scrutiny globally. That could hike compliance costs and potentially limit certain activities or fee structures down the road.
How do macroeconomic factors like inflation and interest rates specifically impact Apollo? Given that unique dual model, it seems like a double-edged sword.
It really is a nuanced and complex relationship. High inflation generally erodes real returns, so that's a headwind. However, higher interest rates, that's actually a tailwind for their massive credit business and for Athene. Allows them to earn wider investment spreads on all that float.
So higher rates are good for them.
Good for parts of the business, yes. But higher rates are a headwind for their traditional private equity business. It increases financing costs for leveraged buyouts and puts downward pressure on asset valuations when they try to sell companies.
So it cuts both ways.
Exactly. The net effect is complex, depends on the balance of their portfolio and the magnitude of the REIT changes. It's a key risk and a key reason for the volatility we talked about. Needs careful monitoring.
What about geopolitical factors like those U.S.-imposed tariffs mentioned for 2025? Are they a direct threat to Apollo?
Not directly targeted at Apollo itself, no, but they are indirectly exposed through their vast portfolio of companies.
How so?
Well, these tariffs are projected to create a broad economic drag. Could reduce U.S. GDP growth by, say, 0.6 to 0.9 percentage points, increase consumer prices. That creates uncertainty for valuations and for mergers and acquisitions activity, complicating deal-making and exit strategies for their private equity holdings.
So a drag on their investments?
Potentially, yes. However, this threat could also present an opportunity. Market disruption and uncertainty caused by things like tariffs can lead to distressed asset valuations, mispricings. For a firm like Apollo, whose whole philosophy is built on contrarian, value-oriented investing, buying assets when they're cheap, this environment could paradoxically create a rich hunting ground.
Buying when there's blood in the streets.
Something like that. A chance to deploy their significant dry powder uninvested capital into attractive long-term investments at good prices. It really raises that question. Can Apollo consistently turn these kinds of threats into opportunities? That's a key to their long-term success.
Fascinating dynamic. Okay, time to bring it all together and answer our central question. Chapter 7, Conclusion. Let's summarize the bull case for Apollo Global Management. What's the argument for why this is a compelling investment?
Okay, the bull case. It rests first on its uniquely integrated and resilient business model. That Athene flywheel providing a durable, low-cost capital base is a huge differentiator, hard to replicate. Second, its dominant scale and premier brand in the high-growth alternative asset management industry, especially that leadership in booming private credit. Third, a disciplined, value-oriented management team with that exceptionally high insider ownership, ensuring strong alignment with shareholders. And finally, from a valuation perspective, the stock appears attractive. It's trading at a significant discount to its primary peers and, based on our educational model, possibly to its intrinsic value.
Okay, that's the bull case. Now the bear case. What are the counter-arguments, the reasons for caution?
The bear case really points to its inherent complexity and its sensitivity to external forces. The business is highly intricate, right? With volatile consolidated financials that can sometimes obscure the underlying performance. It's also heavily exposed to macroeconomic headwinds, recession risks, inflation persistence, and geopolitical risks, like those 2025 tariffs we discussed. Market skepticism is clearly evident too. Reflected in the stock trading below its 200-day moving average, that notable insider selling, and the elevated short interest. Plus, the consolidated entity carries substantial debt due to the insurance operations, and the entire model, while robust, is undoubtedly sensitive to severe market downturns and significant interest rate shocks.
So complexity and sensitivity are the key risks. Let's quickly recap the valuation again. What did our analysis suggest?
Right. Our educational discounted cash flow model estimated an intrinsic value for Apollo stock at approximately $179.17 per share, comparing that to its current share price of $138.74 as of June 24, 2025, and considering its lower PE multiple compared to peers like Blackstone and KKR, there appears to be a notable discount.
Suggesting the market might be overlooking something.
It suggests the market might indeed be overlooking some of Apollo's fundamental strengths, perhaps, as we discussed, due to its complexity or near-term macro concerns.
So what does this all mean for you, our listener? What's the takeaway?
Ultimately, the investment decision here really hinges on your personal assessment of these trade-offs. You have to weigh the compelling fundamental strengths of Apollo's unique business model, its dominant market position, the aligned management, that apparent undervaluation against the significant risks. Risks posed by its complexity, its exposure to market cycles, and the clear skepticism from a segment of the market.
So it comes down to risk tolerance and belief in the model.
Pretty much. For the long-term, value-oriented investor who can tolerate that complexity, who can look through the near-term volatility, the current disconnect between Apollo's fundamental strengths and its market valuation may present a compelling opportunity. The big question for you is, are you prepared to embrace that complexity for the potential reward? And does today's price offer enough margin of safety given those risks?
A lot to think about there. That was a deep dive into Apollo Global Management. We hope you found this incredibly insightful and that it helps you navigate this complex, fascinating company. And hey, don't forget to like and subscribe to the stockanalytics.ai YouTube channel. For just €4.99 a month, members get priority deep dives on tickers. We're planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access.
That's a lot of deep dives.
It is. And if you just want a one-off deep dive on a specific stock, just drop us a super thanks on YouTube.
And please remember, this analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice.
It's crucial.
Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Absolutely. Thanks for diving deep with us. Until next time.